There are moments in markets when the headline is not the real story. The real story is the chain reaction. Oil is one of those stories. Most people look at the price of crude and ask a very simple question. Is it up too much already? Is it too late to buy? Did I miss the move? Is this just another short-term spike that will fade once the news cycle changes? Those are normal questions, but they are not the first questions I ask. When I look at oil right now, I am not mainly asking whether the next $5 is up or down. I am asking whether the world has entered a structural supply shock that the market is still not fully respecting. I am asking whether a disruption in one narrow waterway can force a repricing across energy, inflation, interest rates, consumer demand, corporate margins, and the stock market, because if oil is no longer only an oil trade, then owning oil is not only about making money from oil, it can become a hedge against a broader portfolio shock. That is why I am investing in oil right now. Not because I want a war, not because I want higher gasoline prices, not because I enjoy commodity volatility, not because someone is paying me to say it, and not because I think every investor should blindly copy this position. I am doing it because I see a real risk that the world is underpricing the scale of the disruption, and because my portfolio is exposed to assets that could be hurt badly if oil prices spike and the stock market sells off. So I want to explain the logic clearly. No hype, no fantasy, no pretending this is risk-free, only the system. The Strait of Hormuz is one of the most important oil routes on Earth. Under normal conditions, roughly 20% of global oil supply flows through that narrow passage. 1 out of every 5 barrels of oil in the world has a relationship with this waterway. That is not a small number. That is not a local shipping detail. That is a global economic artery. If a minor route is disrupted, the world can adapt. If a small exporter loses production, other suppliers may replace it. If a refinery has a temporary issue, inventories may absorb it. But when the route carrying around 1/5 of global oil supply is disrupted, you are no longer looking at a normal commodity event, you are looking at a systems problem. The world economy is built on energy moving reliably through choke points. Oil does not simply appear where it is needed. It must be produced, loaded, insured, shipped, received, refined, transported, and consumed. Every step depends on physical infrastructure and confidence. If that confidence breaks, the price does not only reflect current barrels, it begins pricing fear of missing barrels in the future. That is what is happening before the war. Roughly 120 to 150 vessels pass through the Strait of Hormuz on a normal day. Now that flow has collapsed to something closer to 0 to 10 vessels a day. Tankers are not moving normally because the risk is no longer normal. There is fear of Iranian retaliation. There is fear of seizure. There is fear of military escalation. There is fear that the U.S. Navy becomes directly involved. There is the problem of insurance companies either pulling coverage or raising rates so much that shipping becomes economically unrealistic. There is the problem of crews, operators, and owners not wanting to put vessels into a zone where one incident can destroy a ship, create environmental damage, and trigger a wider conflict. This is not a chart pattern. This is physical risk. Oil exports are being choked off because the route is no longer functioning as a reliable route. Now quantify it under normal conditions. About 20 million barrels per Dalton Y pass through the strait. Some of that oil is still getting out. Some is rerouted through pipelines. Some countries still partially export. Some flow continues through alternative channels. So the number is not 0, but the estimated disruption is still around 12 million barrels per Dalton Y removed from effective global supply. 12 million barrels per Dalton Y. That is the number that matters. It is roughly 12% of global supply. It is around 30% of exports. To put that in perspective, the 1973 oil crisis removed about 7% of supply. This disruption is closer to 12% of global supply. That is why people can call it the largest oil supply shock in history, or at least one of the most severe disruptions the modern system has had to absorb. And yet the market reaction still seems too calm. That is the part I keep coming back to. Oil has moved above $100 per barrel. And yes, that is a large move. But if the world has truly lost access to roughly 12 million barrels per Dalton Y, then $100 is not necessarily the price of a full shortage. It may be only the price of the market anticipating a shortage. That distinction is critical. The current price spike is not only reflecting today's physical shortage, it is reflecting fear of future shortages. The market is saying, if this continues, the barrels will not be there. But we may not yet be at the point where the full shortage has been forced into consumption behavior. That means the next phase could be much more severe. Oil is simple at the deepest level: supply and demand. If supply falls dramatically and demand does not fall enough, price has to rise until demand is destroyed. That is the phrase many people do not like, but it is the correct one. Demand destruction: if the world loses barrels, the market has to make somebody use less, prices rise, until consumers, businesses, airlines, manufacturers, truckers, and economies begin changing behavior. Maybe people drive less, maybe airlines raise prices. Maybe factories reduce output, maybe weaker economies slow down, maybe governments release reserves, maybe companies delay activity, but somewhere demand must be destroyed if supply is not restored. The question is not whether oil can go higher. The question is where demand destruction becomes strong enough to offset a supply disruption of this size. In my opinion, that is not necessarily at $130 per barrel. It may not even be at $150. If the disruption persists, oil above $150 is not difficult to imagine. It may be entirely consistent with the supply-demand math. The reason the market does not fully believe that yet is because there is still a buffer. That buffer is inventory. Inventory is the reason oil has not already exploded to extreme levels. At the start of the year, global oil inventories were around 8.4 billion barrels. That sounds enormous. And on the surface, it is enormous. People hear 8.4 billion barrels and think, how can there be a shortage if that much oil exists? But that is the wrong way to think about inventory. Not all inventory is usable. Not all inventory is accessible. Not all inventory is in the right location. Not all inventory can be released quickly. Not all crude is the right type for the refineries that need it. Not all stockpiles are commercial supply. Some inventory is strategic government reserve. Governments may release part of it in an emergency, but they will not empty the entire reserve. Those barrels are held for national security, not daily balancing. Some inventory is stored in locations that cannot easily solve the shortage where it appears. Oil in the wrong place at the wrong time is not a perfect solution. If Europe needs supply and the oil cannot move out of the Middle East because the strait is disrupted, then the location of inventory becomes a problem. Logistics matter. People underestimate logistics because they think of oil like a number on a screen. It is not just a number. It is a physical substance. It requires storage tanks, tanker trucks, ships, refineries, pipelines, ports, crews, insurance, permits, scheduling, and the correct grade of crude. Even if you wanted to dump 1 billion barrels into the market quickly, you cannot simply make a phone call and move it all next week. You need the vessels, you need the trucks, you need the drivers. You need the ports, you need the refineries, you need the system. The system has limits. That is why total inventory and drawable inventory are not the same thing. Some analysts estimate that out of the 8.4 billion barrels in global inventory, perhaps only around 800 million barrels are realistically available in a practical market sense. Other estimates are higher. The EIA may point to something closer to 2.5 billion barrels. OECD estimates may be around 2.8 billion. The exact number is uncertain, but even using the higher range, the math becomes uncomfortable. If 12 million barrels per Dalton Y are removed from supply, then in 100 days the world has to draw down about 1.2 billion barrels. 100 days, a little more than 3 months. And this conflict has already been going on for over 2 months in the source scenario. Now remember something important. Panic does not begin when the final barrel is gone. Panic begins when the market sees inventories falling toward levels that feel unsafe. Markets are forward looking. They do not wait for the tank to hit zero. They react when the buffer stops feeling sufficient. That is why the inventory story is dangerous. The buffer exists, but the buffer is being eroded every day. As long as the buffer remains believable, prices can rise but not explode. Once the market loses confidence in the buffer, the move can become violent. That is the risk. People see oil around $100 or $105 and think the market has already priced the event. I am not convinced. I think the market may be pricing disruption, but not yet pricing a prolonged depletion of usable inventory, while 12 million barrels per Dalton Y remain effectively constrained. That is a different problem. Now look at the historical chart. In 2008, WTI crude oil rose to about $147 per barrel. That happened without a supply disruption of this scale. It happened in a very different macro environment, and that was $2008. If you adjust $147 from 2008 for inflation, the number is well above $200 in today's purchasing power. So when people say oil is already over 100, it must be near the top. I do not think that is the right framework. Nominal comparisons can mislead you. A $100 oil price today does not mean what a $100 oil price meant in the past. The purchasing power of dollars changed. The global system changed. The supply shock changed. If oil reached $147 without this specific choke point disruption in 2008, then it is not hard to imagine much higher prices during a severe disruption in the Strait of Hormuz, especially if the war continues and inventories keep drawing down. This does not mean oil must go there. It means the upside risk is real. That is why I am not treating this as a casual move. Now, I want to be very precise. This is not a wild bet for me. It is a hedge. That distinction matters. I am not buying oil because I want to abandon everything else. I believe in long-term investing. I do not want to sell my positions in gold, silver metals, or the SP 500. I want to stay long. I want to own productive assets. I want to participate in long-term compounding, but I also do not want to pretend my portfolio cannot be damaged if oil spikes violently. If oil prices rise sharply, they can pressure the whole stock market. Higher oil feeds into inflation expectations. Higher inflation can pressure interest rates. Higher rates can pressure valuation multiples. Consumers spend more on gasoline and energy, leaving less money for other goods and services. Corporate margins can fall. Transportation costs rise. Airlines suffer. Manufacturers suffer. Retailers suffer. The economy may slow. Markets may reprice risk. A severe oil shock can become a stock market shock. That is why oil can function as a hedge if oil spikes and stocks fall 20, 25, or 30%. I would rather have a position that offsets part of that damage. If the oil position gains while the rest of the portfolio falls, my total drawdown may be smaller. Maybe the portfolio is down 5 or 10% instead of 20 or 30%. That difference matters emotionally and financially. It can also create opportunity if oil gains because of a shock and the stock market crashes. The profits from oil can be used to buy the dip in long-term assets. That is the logic. I am not simply trying to profit from a crisis. I am trying to protect a portfolio and create optionality if the crisis hurts equities. That is systems thinking. One asset can hedge another. A gain in one place can fund buying in another. The goal is not to predict one perfect outcome. The goal is to survive multiple outcomes. Now, I would be happier if the war ended and the rest of the portfolio continued going up. That is the better world. I do not want a prolonged conflict. I do not want supply disruptions. I do not want higher energy prices hurting ordinary people. I do not want inflation pressure. I do not want a stock market crash. But investing is not about wanting, it is about preparing. There is a real possibility that an oil shock can crash the stock market, so I am being prepared. That is the whole point. Now, we need to discuss the risks because this is absolutely not risk-free. The biggest risk is de-escalation. If the war escalates, if the strait reopens, if insurance normalizes, if tankers resume movement, if export flows recover, then the oil price can fall quickly. A position built on disruption can lose money when disruption fades. That is the obvious risk, and it is not small. Oil is volatile. Commodity markets can move violently in both directions. A rumor of negotiation, a ceasefire, a military breakthrough, a diplomatic resolution, or a sudden release of inventory can change the price quickly. If you are positioned too large, you can be hurt. That is why position sizing matters. A hedge should protect the portfolio, not become the portfolio. This is one of the most important principles. People hear a thesis and become overconfident. They say, if oil can go to 150 or 200, I should put everything in oil. That is not investing, that is concentration risk. A hedge must be sized so that if the hedge loses money, the overall portfolio survives. If the hedge wins, it offsets damage elsewhere. If it loses, the rest of the portfolio may benefit from the outcome that caused the hedge to lose. For example, if peace returns and oil falls, that may be positive for stocks, consumers, and inflation expectations. So the rest of the portfolio may benefit. That is the logic of a hedge. One part can lose because another part wins. You do not need every position to win in every environment. You need the total system to be resilient. Now let us talk about why reopening the strait may not be simple. Some people assume the United States can simply use military force and reopen it. Militarily, the United States is much stronger than Iran, that is obvious. But military strength does not mean the path is easy. Iran is not a simple target. Geography, terrain, missile capacity, asymmetric tactics, naval mines, drones, proxies, and regional infrastructure all complicate the situation. It is like a lion fighting a porcupine or a honey badger. The lion may be stronger, but the fight can still be costly, even if the United States could force the strait open. At what cost? If military escalation causes Iran to attack oil infrastructure across the Gulf, then reopening the waterway may not immediately restore exports. The route may be open, but the infrastructure that produces, loads, or ships the oil could be damaged. That is the nightmare scenario. The world could win the rout and lose the infrastructure. In the short term, that would not solve the supply problem. That is why this is a bad situation. It is not enough to say the US is stronger. In markets, the question is not who is stronger in an abstract sense. The question is what happens to supply, risk, infrastructure, and confidence during the process. If the cost of reopening is damage to Gulf oil infrastructure, then the market may still face shortages. This is why I do not think the situation should be brushed off. The system is fragile because so much oil depends on a narrow passage and a politically explosive region. Now, why is the market not fully appreciating this? I think part of it is anchoring. People look at the oil price and compare it to past nominal highs. They see oil above 100 but below the 2008 nominal peak. They think it is not at record highs. So maybe the situation is manageable, but nominal price anchoring can be dangerous, as I said before. $147 in 2008 is not the same as $147 today. Inflation changed the meaning of money. A price that looked extreme then may not be extreme. Now, in real terms, if the current disruption is larger than previous crises, then comparing today's price to old nominal levels may understate the potential upside. Another reason is inventory. The buffer delays panic. As long as inventories can be drawn, shortages may not appear immediately. Consumers still find fuel, refineries still operate, ships still arrive with supply from somewhere. The visible shortage is not yet everywhere, but the invisible drawdown is happening. This is how crises build. At first, the system absorbs the shock. Then the buffer weakens. Then the market notices the buffer is not enough. Then the price moves violently. I am not saying this sequence is guaranteed. I am saying that is the risk. And when the risk involves energy, it can spread quickly to the rest of the economy. Now let us break down the inventory issue more carefully. Strategic reserves exist for emergencies, but they are political assets as much as economic assets. Governments may release some barrels to calm the market, but they will be careful not to drain reserves completely. A government that empties its strategic reserve loses protection against the next stage of the crisis. Commercial inventories are also not all equal. Some oil is tied to specific contracts, some is already scheduled, some is in transit, some is not the right grade, some requires refining capacity that may not be available. Some is located where transportation is constrained. Refineries cannot process every crude equally. A refinery designed for one type of crude may not efficiently process another heavy crude, light crude, sweet crude, sour crude. The chemistry matters. So oil exists somewhere is not enough. The right oil must reach the right refinery at the right time. This is why commodity logistics are often underestimated by financial markets. Markets can reprice instantly. Physical systems cannot move instantly. A spreadsheet can say there are billions of barrels. The real world asks where they are, what type they are, how fast they can move, and who is willing to ship them through a war zone. That is the difference between accounting inventory and usable supply. Now let us discuss demand destruction again. The world uses oil because oil is embedded in modern life. People need transportation, businesses need logistics, airlines need jet fuel, farmers need diesel, militaries need fuel, chemical plants need feedstock, consumers need gasoline, ships need fuel, trucks need fuel. Demand is not perfectly flexible. If oil rises from $60 to $100, some demand may fall, but much remains because economies are built around energy use. If oil rises further, demand destruction becomes more meaningful, but the price required to destroy enough demand may be much higher than people want to believe. That is why $130 or $150 may not be sufficient if the supply shock persists. Again, I am not saying that must happen. I am saying the mechanism points in that direction if the disruption continues. High prices are the market's way of rationing limited supply. That is not pleasant, but it is how commodity markets work. When there is not enough, price decides who uses less. Now, what does this mean for stocks? Energy is an input cost. When energy rises sharply, the whole economy feels it. Consumers feel it first. If gasoline rises, households spend more at the pump. That money cannot be spent on restaurants, clothing, electronics, travel, or other discretionary goods. Consumer spending weakens. Businesses feel it next. Transportation costs rise. Shipping costs rise. Airlines pay more for fuel. Manufacturers pay more for energy. Farmers pay more. Retailers may face higher logistics costs. Margins get squeezed unless costs can be passed to customers. Inflation expectations can rise. Central banks may become more cautious. Interest rates may stay higher for longer. Equity valuations may compress. Investors may demand more risk premium. Growth stocks can suffer. This is how oil becomes a market crash risk. It is not only the oil company's problem, it can become everyone's problem. That is why an oil position can hedge a stock-heavy portfolio. If the shock worsens, oil may rise while stocks fall. If the shock resolves, oil may fall while stocks recover. That is the structure I am trying to create. A hedge is not designed to be comfortable every day. It is designed to help in the scenario that hurts the rest of the portfolio. Now let us discuss how to think about entry. The source mentions not chasing the initial spike and waiting for a pullback before initiating a position. That is important because even if the thesis is strong, price still matters. Buying after a sharp move can be dangerous. Commodity markets can whip around, a pullback can provide a better risk-reward, but it does not remove risk. This is another principle. A good thesis at a bad price can still produce a bad outcome. So if someone believes in the oil hedge, they should not simply buy because the story sounds scary. They need a plan, entry, position size, risk limit, what invalidates the thesis, what event reduces the need for the hedge, how to take profits, how to use profits if the hedge works, when to stop adding. This is how you treat a trade or hedge seriously. The source mentions getting in around the 80s while oil later moved near 105. That means some of the move already happened for a new investor. The question is different. Is there still enough upside compared with the downside? That depends on whether the disruption persists and whether inventories continue drawing down. Again, no certainty, only probabilities. Now let us talk about position sizing more concretely. If the purpose is hedging, the position should be large enough to matter but small enough not to destroy you if the hedge fails. A small position may not offset a portfolio drawdown. A huge position may turn the hedge into a speculative bet. The correct size depends on the portfolio risk tolerance, liquidity, time horizon, and how oil is owned. Oil futures, energy ETFs, oil producers, stocks, options, and commodity funds have different risk profiles. Some instruments involve leverage, roll costs, tracking error, or company-specific risk. Owning oil is not one thing. There are many ways to express the view a person should understand the instrument before using it. If you buy oil futures without understanding futures, you can be hurt. If you buy leveraged ETFs without understanding daily reset and decay, you can be hurt. If you buy oil producers, you are not only buying oil price exposure, you are buying company management, costs, reserves, political risk, dividends, debt, and operational execution. If you buy an oil ETF, you need to understand how it tracks oil and what costs are embedded. So the thesis may be about oil, but the vehicle matters. This is another place where people get into trouble. They hear the macro argument and choose the wrong instrument. A good idea expressed through a bad vehicle can still fail. Now the source is focused on why oil may go higher and why it hedges the portfolio. It does not need to become a complete investment manual, but the principle is worth stating. If you are going to act, know what you own. Now let us consider the opposite scenario. What happens if the war ends quickly? The strait reopens, insurance normalizes, tankers resume, flows return, supply fear fades. Oil falls. In that scenario, the oil position may lose money, but the rest of the portfolio may benefit. Stocks may rise. Inflation fears may cool. Interest rate expectations may improve. Consumer sentiment may strengthen. So the hedge loses because the risk it was hedging went away. That is not necessarily a failed hedge. It is how hedges work. You buy insurance. If the house does not burn down, the insurance premium was not a profit center, but it helped protect you from a scenario you did not want. The difference is that an oil hedge can sometimes make money if the bad scenario happens, while traditional insurance simply pays claims. But the mindset is similar. You do not want the bad event. You prepare for it. That is the correct psychological frame. Now let us discuss the possibility that oil goes sideways. If the disruption persists but inventories remain enough, oil may move sideways for a while. The position may neither win nor lose dramatically during that period. Patience becomes difficult. People want immediate confirmation, but systems often take time. Inventory drawdowns are gradual until they become urgent. This is why the thesis should have a time frame. If your thesis is that inventories will erode over 100 days, you cannot demand confirmation in 3 days. But if the key risk resolves, you must adjust. Time frame and invalidation must be defined. A trade without a time frame becomes an emotional argument. A hedge without an exit plan becomes a permanent position, whether it still makes sense or not. That is dangerous. Now, what signals matter going forward? Watch vessel traffic through the strait. Watch insurance rates for tankers. Watch statements from major exporters, watch pipeline rerouting capacity, watch global inventory drawdowns, watch strategic reserve releases, watch WTI and Brent spreads, watch refinery margins, watch gasoline prices, watch shipping rates, watch military escalation or de-escalation. Watch whether governments treat this as temporary or structural. These are the signals, not one headline. A pattern, the market will have noise, the system will reveal itself through flows. How many barrels move? How fast are inventories falling? Can demand adjust? Can supply reroute? Can the route reopen without infrastructure damage? Those are the questions. Now, there is also a political dimension. If the situation becomes severe, governments may try to intervene, they may release strategic reserves, they may pressure producers, they may coordinate with allies, they may offer naval escort, they may impose sanctions, they may negotiate, they may threaten military action. Each action has consequences. A strategic reserve release may calm the market temporarily but reduce future buffer. Military action may reopen shipping or escalate infrastructure attacks. Negotiation may reduce risk or fail. Insurance markets may respond faster than governments. The oil market is not isolated. It is tied to politics, military strategy, diplomacy, and physical infrastructure that makes it complex. But the core supply, demand math remains. If barrels are missing and demand does not fall enough, price rises. Now, let us talk about why ordinary investors should care even if they never buy oil. Oil shocks affect inflation. Inflation affects interest rates. Interest rates affect mortgages, credit cards, business investment, and stock valuations. Oil shocks affect consumer spending. Consumer spending affects corporate profits. Oil shocks affect geopolitics. Geopolitics affects risk premiums. So even if you never own a barrel, oil can influence your financial life. This is why I do not treat energy as a niche topic. Energy is one of the foundations of the economy. When the price of energy moves violently, the whole system adjusts. If you hold the S&P 500, you are exposed to oil indirectly. Some companies benefit, many companies suffer. The index may fall if the shock is severe. That is why the hedge idea exists. You do not need to become an oil trader to understand that energy matters. Now, let us think through the portfolio example. Suppose a person has a long-term portfolio of stocks, metals, and broad market exposure. They do not want to sell because they believe in the long term, but they worry that an oil shock could trigger a major drawdown. So they allocate a modest portion to oil exposure. If oil spikes, that position may offset losses. If oil profits are realized, they can be used to buy depressed long-term assets. If the shock resolves, oil may lose, but the long-term portfolio may benefit. That is a coherent structure. The oil position is not a rejection of long-term investing. It is a risk management layer. This is important because some people think hedging means you are bearish on everything. Not necessarily. Hedging can mean you are long-term bullish but short-term aware of a specific risk. A good investor can hold both thoughts. The world can get better over the long run. A portfolio can suffer in the short run. If one shock hits, prepare for the shock without abandoning the long-term plan. That is the mindset. Now let us talk about the emotional advantage. When markets crash and you have no plan, fear controls you. When markets crash and you have a hedge working, your emotional state changes. You may still lose money overall, but less. You may have gains in one bucket while another falls. You may have dry powder. You may be able to buy instead of sell. That emotional advantage can be worth a lot. Many investors fail not because their assets are bad, but because they cannot tolerate the path. A hedge can make the path tolerable. If a hedge keeps you from panic selling your long-term portfolio, it may be valuable even if it does not maximize returns in every scenario. This is why portfolio construction is not only about expected return, it is about behavior under stress. A portfolio you can hold is better than a portfolio you abandon. Now, let us talk about oil as a hedge versus oil as a speculation. A hedge is sized and connected to another risk. A speculation is often sized around excitement. A hedge has a scenario, a speculation has a story. A hedge has an exit plan. A speculation often becomes, I will know when I know. A hedge is judged by how it affects the portfolio. A speculation is judged by whether the position itself makes money. I want to be clear that my framework here is hedge first. Yes, the oil position can make money, but the strategic purpose is to protect against a portfolio shock caused by energy. That distinction helps discipline. If oil rises enough to offset stock losses, I should think about using gains according to the plan. If the war ends and oil falls, I should not emotionally double down just because I was once right about the risk. I should evaluate whether the hedge is still needed. This is how you avoid becoming attached to a thesis after the world changes. Now, let us think about the market's underappreciation of the problem. A 12 million barrel per Dalton Y disruption is hard to grasp because people do not see barrels. They see gasoline prices, headlines, and maybe oil charts. But the actual supply chain is invisible to most consumers until the problem reaches the pump. By the time it reaches the pump, the market may already have repriced. This is why investors must think upstream. Do not wait until shortages are obvious to everyone. Markets move before shelves are empty, before tanks are low, before the pain becomes visible to the average household. The current price above 100 may reflect some of the risk. But if the disruption continues and inventories shrink, the next repricing can be much more severe. That is the core thesis. Now let us also acknowledge that commodity markets can overshoot both ways. Oil can rise too much on fear and then fall sharply on relief. It can spike on headlines and collapse on a rumor. It can be manipulated by inventories, policy, OPEC decisions, sanctions, and positioning. That is why the trade is risky. Commodity markets are not gentle. They are not stable savings accounts. They are volatile systems reflecting physical supply, financial speculation, and geopolitical risk. So a person entering this trade must be able to handle volatility. If a 10 or 20% move against you would force panic, the position is too large or the instrument is wrong. Again, position sizing is everything. Now, let us consider inflation. Adjusted oil again because it is important. People often fail to adjust historical prices. They say oil was $147 in 2008 and today it is around $105, so we are far from the old high. But if $147 in 2008 is more than $200 in today's money, then the real comparison changes. The current price may be much lower in inflation-adjusted terms than people think. That does not mean oil must go to 200, but it means old nominal highs should not be treated as fixed ceilings. Markets trade in today's dollars. Costs, wages, equipment, shipping, insurance, government budgets, and debt levels have all changed. A nominal chart can hide this. This is why serious investors think in real terms, not just nominal terms. Now, let us talk about the relationship between oil and central banks. If oil spikes, headline inflation can rise. Central banks often look through temporary energy shocks. But if the shock persists, it can feed inflation expectations. Consumers may demand higher wages, businesses may raise prices, governments may respond politically. If inflation expectations become less anchored, central banks may hesitate to cut rates or may even maintain tighter policy. That can hurt stocks. High-growth companies are especially sensitive to discount rates. A higher rate environment can compress valuations. A market already priced for smooth conditions may not be ready for an inflationary energy shock. So oil can pressure equities not only through consumer spending and margins, but also through monetary policy expectations. That is another reason it can hedge a stock portfolio. Now let us think about sectors. Energy producers may benefit from higher oil prices. Airlines may suffer, transportation may suffer, consumer discretionary may suffer, industrials may face cost pressure, chemical companies may face input pressure, utilities may have mixed effects depending on fuel sources, financials may react to rates and credit risk, technology may suffer through valuation compression. The stock market is not one thing, but a broad oil shock can affect many sectors. If the shock becomes severe enough, correlations can rise. Many stocks fall together because investors reduce risk. In that environment, having a hedge tied to the shock source can be helpful. Now, what if oil producers benefit so much that the energy sector lifts the index? That can happen to some degree. But energy is only a portion of broad equity indexes. If the shock is severe enough to damage consumption, margins, rates, and sentiment, the positive effect on energy stocks may not save the whole market. That is why direct oil or targeted energy exposure can be different from simply owning the S&P 500. Again, know what exposure you have. Now let us discuss the broader lesson. Every portfolio has hidden vulnerabilities. A portfolio heavily exposed to stocks may be vulnerable to a sudden inflationary oil shock. A portfolio heavily exposed to bonds may be vulnerable to rising rates. A portfolio heavily exposed to cash may be vulnerable to inflation. A portfolio heavily exposed to oil may be vulnerable to peace. A portfolio with no liquidity may be vulnerable to forced selling. The goal is not to eliminate all risk. That is impossible. The The goal is to understand which risks can hurt you most and then design offsets. That is what I am doing with oil. It is an offset to a specific risk, not a religion, not a permanent identity, a tool. Now, let us talk about the end game. If oil spikes sharply because the strait remains disrupted and inventories fall, there must be a plan. Do you take profits at a certain price? Do you sell in stages? Do you use gains to buy stocks that fell? Do you hold until shipping normalizes? Do you watch inventories? Do you watch military developments? This must be thought through before the price moves. If you wait until the position is up dramatically, greed enters. You may believe it can only go higher. If you wait until the position falls dramatically, fear enters. You may sell at the wrong time or double down emotionally. Rules matter. For a hedge, the exit can be connected to the risk. If the risk fades, the hedge fades. If the risk materializes and the hedge works, harvest some protection and redeploy according to the plan. This is a disciplined approach. Now, let us talk about the morality of investing in oil during crisis. Some people may feel uncomfortable profiting from a supply shock. I understand that, but from a portfolio perspective, hedging is not the same as hoping for the crisis. Insurance against a bad event does not mean you desire the bad event. It means you recognize that bad events happen and you need to protect your family and capital. If the crisis ends, I will be happy. If the crisis worsens, I want to be prepared. That is the moral position: prepare without wishing for harm. Now, let us return to the opening claim. The world may be experiencing one of the largest oil supply shocks in history, and most people do not realize it because the full shortage has not yet appeared in daily life. The Strait of Hormuz is not just another shipping lane. It carries around 20% of global oil supply. Traffic has collapsed from 120 to 150 vessels a day to something closer to 0 to 10. Roughly 12 million barrels per Dalton Y may be effectively removed from supply. That is larger than the supply loss of the 1973 crisis as a share of global supply. Oil above $100 may not be the full shortage price. It may only be the anticipation price. Inventories are cushioning the blow, but usable inventories are limited and being drawn down rapidly. If the disruption continues, the market may lose confidence in that buffer before the tanks are empty. That is when the move can become more violent. The price required to destroy enough demand may be much higher than the market wants to believe. In that environment, oil can serve as a hedge against the broader stock market damage that a severe energy shock could cause. That is the logic. Now, the risk is real. De-escalation can crush the trade. A reopening of the strait can restore supply. Strategic reserves can calm the market. Demand can weaken for other reasons. Prices can overshoot and reverse. A bad instrument can perform differently than expected. A position that is too large can become dangerous. So this must be sized as a hedge, not treated as a certain fortune. But ignoring the risk because oil has already moved is also dangerous. The right question is not whether oil is up. The right question is whether the current price fully reflects the duration, size, and second-order effects of the disruption. I do not think it does. That is why I am invested. Not because I know the future, because I can see the asymmetry. If the shock resolves, I may lose on oil. But the rest of my portfolio may benefit. If the shock worsens, oil may protect me while stocks struggle. That is a portfolio decision. Now, let me close with the principle. Investing is not about finding one asset that wins in every world. That asset does not exist. Investing is about building a system that can survive different worlds. A normal world, an inflationary world, a war shock world, a market crash world, a recovery world, a world where the strait reopens, a world where it does not. Oil is one tool for one type of world right now. The probability of that world seems higher than the market is admitting. So I want exposure carefully, deliberately, with an exit plan, with respect for the downside, and with the understanding that this is not just an oil trade. It is protection against the chain reaction that can begin when one narrow waterway stops functioning and the world suddenly realizes that the energy system was much more fragile than it looked. That is why I am investing in oil. Not to chase, not to panic, to prepare. Because in markets, the worst time to buy protection is usually after everyone finally agrees that protection was necessary.